Hey traders, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, May 20, 2024. We are looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? Well, first and foremost, we have another market activity or another market session where we were in a very, very tight range. She's actually still operating as I make this video. I'm starting it roughly 5 minutes before the closing bell. It's not going to materially change the outcome of today's video, regardless of where they close from here. But as you'll see, they are still ticking away. This is a 5-minute chart and the market still is operative. Doesn't matter at the end of the day. So where are they now? They're very close to the trend line that I've had my eye on for quite some time. We had another lengthy conversation this morning in the live trading room about this trend line, and here's the concept. The concept is they're heading for a destination, and each beginning has an end, each ending has a new beginning. That's something that's prevalent throughout our lives. Therefore, a fractal of what's prevalent throughout our lives is the market itself. And therefore, I'm still thinking that if they hit the trend line sooner than later, they're likely to have a reaction in the other direction. However, the caveat is this. As you can see now, for about 4 days, they've been eating time off the clock under the trend line. The longer they eat time off the clock, the more likely they are building energy to make a move higher, and the longer they do it sideways, the higher they can go, which at this point in time would be above the trend line. Any way you look at it, the trend line coming from a very, very long-term chart, even spiking it just for a few days or so, isn't necessarily the end of the world, nor is it an issue until they start getting above, closing monthly above that trend line from a big picture perspective. Tomorrow, mind you, is in fact Turnaround Tuesday. Now, at the end of the day today, which comes up in a couple of minutes here, the market may just finish flat plus or minus a rounding error, but nevertheless, the market was up a little bit earlier. Tomorrow is Turnaround Tuesday. I would have your radar up and operational. Why else do I say that? And here's another discussion that we had in the live trading room today. We've got what's called waning velocity. What does that mean? It means at some point when the market goes in one direction, there comes a point when the rubber band gets stretched where it's got to either break apart and the market will just keep going up indefinitely, or it's got to snap back, reset the tape, if you will. From a longer term perspective, not an hourly chart, not a half a day chart, not a 1 day chart, we've got waning velocity. What does that mean in English? What does all that mean wrapped up, put in a box and a bow on top? It means I'm looking for a turn. Doesn't have to be a tremendous turn. I'm looking for a corrective turn, even if the market comes down 50, 60, 75 points in the ES, $6, $7 in the SPY. I'm looking for some kind of corrective move. That is normal garden variety market behavior. The ideal scenario, and the market doesn't necessarily give us ideal, but the ideal scenario is to actually satisfy, hit the trend line, reach the objective, reach the destination, and then have a garden variety pullback of sorts. What would be a legitimate place to have a pullback to? How about the most recent breakout area? Where is that? It's the blue horizontal trend line. You can see it more clearly when you look at the weekly chart. Market ran up to that place, was summarily rejected. Once she gets above that place, automatically becomes by definition a breakout area. The market will come back to run a test of the most recent breakout area. Write that down, put it on a sticky note. That number is 524.61, roughly About 5.5 SP dollars or so. Funny how that works. That translates into the same 50, 60, 70, 75 S&P handles for a corrective type of move. That would be normal garden variety market behavior. Markets go up, markets go down. Nothing ever goes in a straight line indefinitely. However, human nature and our minds get programmed when we're watching the market go in melt-up mode. We lose faith in the fact that the market will ever come down. We're programmed to think by nature of what's happening now will continue to happen into the future. We're programmed to think that the market's just going to continue to melt up indefinitely. The shorts have been issued a pie in the face. They've been taken behind the woodshed one more time for the umpteenth hundred time. The market's job is to make as many investors as traders look like fools as much of the time as possible. Write that down. Put it on a sticky note. Once again, just putting in perspective certain things from a longer time frame, bigger picture perspective. Look at the weekly chart picture and you see the trend line and you say, picture this. We're close to the trend line now, and let's just suggest for a second we fast forward 3 weeks, 6 weeks, 12 weeks. It doesn't make any difference. We fast forward some point in the future and you could look back and say that, hey, look, the market got to the trend line, spiked it a little bit, and then pulled back away from the trend line. We see these things all the time when you look back after the fact, being the Monday morning quarterback, and you look at a big picture perspective like a weekly chart, you say, hey, that would be normal garden variety stuff. When you narrow it down to the daily noise and the intraday noise, they could be above the trend line by 10, 20, 30, 40 S&P handles. Pull back, you look back in 2 months, and on a weekly chart, it looks like a little tiny tail peek its head above the trend line and then come back down. That could be worth 20, 30, 40 S&P handles. In the heat of the moment, the trend line looks like it's bogus. It was wrong. When you fast forward and you just have the benefit of time on your side, you can look back from a longer picture perspective, larger picture perspective, and see, hey, they spiked it by a little bit and pulled down. And when you look intraday, that little bit still could have been a lot from a trading intraday perspective. It's all a matter of how you want to look at things, what your perspective is. Is it short term? Is it bigger picture? Is it no patience? What is it that you look at the charts? All perspectives or one-sided perspective? You decide. That's an awareness that you have to be cognizant of yourself. Put that in your pipe and smoke it. So what was going on today inside the numbers? Well, we already know the big picture is we had a very narrow ranging slow tape again, low participation, low volume, summer doldrum, Monday summer doldrum, kinda sorta. Kinda sorta is a technical term. We have some early numbers on the board. You can pause the video and I urge you to do so. Read the notes, go back to the chart and double check the work. I'm going to point out a few things of importance. We're looking at the bullish camp and a bull pivot like the one at 530.60. So what does that mean? That means if the market's above 530.60, it begins to get more in the bullish camp. We expect higher prices to come yet, as long as they're above 530.60. You know, right of the vertical is today's activity. 5-minute SPY chart, 530.60 is your trend line. You can see above she's bullish, comes down, almost runs a test, came a few pennies short, bounces. Once she gets below, eats some time off the clock below, no dice, can't even go back for a retest. That was my pivot number today. Below, she's bearish. Above, she's bullish. Bearish is a relative term, not really bearish, just not bullish. There's nothing bearish on the chart right now. We're discussing the trend line up today at 533. If they were to go up and get it, that was an interesting place. Still interested in a short the pants off the market at 533 with 3 hands. That was good Thursday, Friday, even today. even tomorrow. Then after that, it's going to start to wane a little bit because she's eating too much time off the clock underneath 533. Takes the luster off the trade. Write that down, put it on a sticky note, time mark this spot because we might have to come back and review it at a future date. Let's see what else we have as the day starts to get underway. What do we have as the scoop? This is before the open, about 9:15 today. If above 530.60 is a target for overhead resistance if they get there sooner than later. Dropping below the flat line opens the door for a lower number. They never did get there today. It was a bounce back type of place. They came up about 30 cents short or so. Very slow tape. Hard to get to the numbers in a slow tape. So right away, I'm saying 530.60 is the current target for traders that were long, and we did have a bucket full of traders in the live room that did ride the tape early in the morning up to 530.60. Then we're saying that's overhead resistance. And then what you'll read later is it's overhead resistance, but they can get as high as or come up short of at least somewhere in the neighborhood of 531.54, which was simply Friday's high, the all-time high. So that zone up there was overhead resistance, and that's what you're going to find in the notes. Now watch this. We switch over to a 15-minute chart, and you can see. Got up into the zone, took most of the day. Finally, in the afternoon, after lunchtime, they broke down a little bit, and they finished off in, well, on this 15-minute chart anyway, a bearish, flaggish kind of situation. And you could see here on the hourly chart, what did they do? They essentially ran a test of this hourly breakup candle low. Funny how that works. Tested it here, bounced off of it, and then stayed down there for the majority of the day or the rest of the day. However, they never finished below it. Below that tomorrow is the negative thing. We can start there. Things morph from small time frames onto larger time frames. You need to understand where the market is from the larger time frame down to the smaller time frames. And when you can balance those two things, what's she doing on a very short-term basis? What is she actually doing on a longer-term basis? That's where you can start to develop the trades from the trend is your friend perspective. You want to be counter trend? You can. You want to be with the trend? You can. It just depends on what your perspective is, what type of trade you're looking at. You're looking at an intraday trade. You're looking at a short-term swing trade. You're looking at a longer-term positional trade. All those things come off looking from longer-term charts and shorter-term charts. Again, let's add that to the pipe and smoke it. Now, let's finish up the notes here and just show you the notes from the rest of the day so that you can get a sense for what goes on here inside the numbers. Is it something for you? Are you interested in trading the S&P? Do you trade the S&P? This is something that could be helpful. Not much of last week, not yet really this week, but the market will pick up. What follows slow markets, low volatility is faster markets, higher volatility. It's coming. It just never feels like it's coming until she arrives. What do we have here? We're switching gears over to the lazy swing trader automagical algo system. We had an exit today in Microsoft. We bought Microsoft at the lows, rode it up, took one profit, took a second profit today. We still have a third profit target. Just so funny how today's high within a few pennies was the actual profit target. Was not created today. It was a profit target when the trade was issued. How does that work? Works very well. Lazy swing trader automagical algo system. 389.5 to 426, give or take. Second profit target. This was already a risk-free, emotionless trade. What I want to know, other than us, other than the folks in the lazy swing trader product, who was buying Mickeysoft down here? Wouldn't you think that most people were about to get scared away and sell their long positions, and some of them did? Who did they sell them to? They were liquidity. Now, that's a conceptual thing. Microsoft has its own liquidity. It's as liquid as rainwater or the ocean. But just from a concept perspective, people run for the hills when stuff goes on sale. Funny how that works. That's how it works in this business. This is an old trader adage, investor adage. Someone that's been around the markets for a long time has heard this before. The very, very best spots to get into a trade feel like they're the worst spots to be doing what you're doing. And when you feel like that, it's usually right. When it feels really, really wrong, it's usually really, really right. Lazy swing trader, automagical algo system. Anything doing here in Camp IWM? Now, they're eating time off the clock for about 4 days now, underneath a number that is unsatisfied. What does that mean? Well, different than the trend line off of a long-term multi-year chart, this is a number that they had a choice to get to, decided not to get to, and we're talking right now about 210, and they're eating time off the clock under that number. So we're going to, for now, discard that as a real bona fide destination and say they're eating time off the clock to go higher, building energy to go higher. Now, what if they don't? What if they go down? Well, so be it. They still never got to the target of 210. I'm saying 210 is no longer a short if it ever was. It's no longer real overhead resistance if it ever was, because they've been eating time off the clock for 4 trading sessions right underneath it with every opportunity to go get it. That diminishes the importance of 210. More ganja for the pipe. What's going on with the folks down at the transportation department? While the S&P and the IWM have been running sideways for about 4 days, Team Transports has been coming down for about 4 or 5 days. Quite interesting. What are they? My second favorite market leading indicator and a number one canary in the coal mine. When we move over to a weekly chart, can we say that this is a move that looks like a bearish wedge that was capped thus far at the 20-period moving average? Yes, we can. A number one canary in the coal mine. Lower high, getting back below moving averages. This is bearish until or unless they break the chain. This could certainly be a pullback with another thrust, if you will, in the upward direction. We don't know yet. We take the market currently at face value. Anything wrong with the Q, people? Absolutely not. Nice healthy update, $3 and change, about 0.7%. New highs, nothing wrong, nothing to see here. In a case like this, new highs, you're looking for some kind of sign and or signal of a trend change. Where do you get that from? Out of the Lazy E-mini Trader course. At new highs, we're looking for the market to give us something to trade against. A sign and or signal, a reversal candle on volume, a doji candle, a tail candle, an intraday reversal, some kind of a sign and or signal that we can trade against, meaning you know where that particular scenario would be wrong on the short side against the high they just made. They haven't made anything like that, and therefore we're just spectators in Q land. How about the financials? How about a down day about 1.3%? That raises a little bit of an eyebrow. We can call the canary in the coal mine financial situation existence. They're not my favorite a number one canary like the transports are, but they still are canary-ish. If the financials are cracking, there could be something going on under the hood of the market. Nothing wrong with the financials, nothing to see here, move it along. However, all of a sudden, a down day in the financials, it's an outlier. Something's going on. We're going to pay attention over the next trading session or two. Remember, we're looking for a turn anyway. Big picture perspective, above all the moving averages, trend is your friend, nothing to see here. However, here is a breakout area. Market ran up to this spot, pulled back, broke out through it, coming back to retest potentially a most recent breakout area coinciding with a convergence of moving averages, the 20 and the 50 period moving average. You start to see the makings of a full stack, at least for a minimum of an intraday bounce situation or more. Might want to write that down, put it on a sticky note, not in the pipe. What about Smash Mouth? The Philadelphia Semiconductor Index, anything to see here? No. They're eating time off the clock. The only objective they have is pushing to run a test, pushing higher, that is, to run a test in the vicinity, and they kind of already are in the vicinity of the breakdown candle high, which is the high. Can they test it? Can they spike it? Will they come up short? We don't know the answer. Those are the options. They've been eating time off the clock, and the same thing applies that we learned earlier in this video. The longer they eat time off the clock, the more likely they are to make a move higher. The longer they eat time off the clock, the higher they can go, theoretically speaking. Have I told you how much I appreciate each and every one of you? Without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.